For nearly a decade, the Canada-China relationship stood frozen, shaped by tariffs and suspicion. Then one visit reopened channels worth $130 billion in annual trade, from canola to electric vehicles. Ottawa adjusted duties, Beijing eased restrictions, and markets recalculated shipping routes and prices. Washington noticed as its North American plan suddenly faced new variables. This was not a free trade pact, but a managed corridor built on quotas and inspections. Who writes the next chapter for Canada and prosperity? Welcome to Geo Capitalist, where we examine the forces shaping power and prosperity with clarity and context. Today we explore Canada's $130 billion China trade reset and how it just reshaped Washington's strategy. Subscribe to Geo Capitalist for more analysis on the global economy, geopolitical risk, and international trade. The agreement announced after the visit did not resemble the sweeping trade pacts of the past. Instead, it adjusted specific gates that control how goods move between the two economies. Canada reduced the extraordinary duties on a limited number of electric vehicles, while China lowered tariffs that had effectively closed its market to Canadian canola and several food products. Alongside these steps, 6 cooperation frameworks were signed covering energy, forestry, food inspection, and law enforcement. None of this created unconditional openness, yet it rebuilt predictability, the ingredient investors value most. For companies planning harvests or production schedules, the difference between a closed door and a managed corridor can be measured in payrolls and shipping contracts. The figure of $130 billion represents the scale now back on the negotiating table, the sum of annual flows in resources, machinery, and services. In the language of economic policy, this is a recalibration rather than a revolution. But recalibrations matter. International trade moves through rules more than through goodwill, and small adjustments in those rules can redirect global economy patterns within a single season. The question is not whether the reset is perfect, but whether it establishes a stable foundation for the next phase of Canada's strategy. The timing of the reset reveals as much as the text of the agreements. Canada entered 2026 facing a more fragmented global economy, where reliance on a single buyer had become a strategic risk. Prairie farmers were preparing planting decisions without clarity on their largest historical market, and port operators on the Pacific coast were planning capacity for uncertain cargo. At the same moment, North American trade rules were under review, reminding Ottawa that economic security requires more than one door. The decision to engage Beijing was therefore less about ideology and more about arithmetic. For China, food stability and resource reliability carried equal weight. Drought cycles and shifting supply chains made predictable imports valuable, while Canadian standards offered credibility to Chinese consumers. Both sides discovered overlapping incentives, even amid political differences. This is how modern economic policy often advances, through narrow corridors rather than grand gestures. A single tariff line can shape the global economy more than a summit photograph. If countries trade because they must, not because they agree, what does that mean for the future design of international trade? The reset suggests that necessity still guides strategy, and Canada chose to act before options narrowed further. No product explains the reset better than canola. For the prairie provinces, this crop is not a symbol, but an economic spine connecting farms, railways, crushers, and coastal terminals. When Chinese duties rose in previous years, shipments diverted to smaller markets at lower prices, and the effect traveled through equipment sales and rural employment. The new terms reopen the largest single destination just as farmers prepare seeding plans, restoring a measure of price stability. Vancouver and Prince Rupert ports expect fuller schedules, while fertilizer demand and storage activity follow the same rhythm. This illustrates how international trade reaches far beyond diplomats. A change in one tariff can influence the global economy of entire regions. Canadian producers have learned to diversify, yet scale still matters, and China remains a buyer few can replace. The reset therefore operates like a financial insurance policy, reducing uncertainty rather than guaranteeing profit. Can a single corridor anchor confidence across the West? The coming harvest will provide the first answer. The other pillar of the agreement concerns electric vehicles, a sector sitting at the intersection of climate goals and industrial policy. Canada eased duties within a defined quota, allowing consumers access to more affordable models while protecting domestic assembly lines from sudden disruption. For Ottawa, the calculation was practical. Faster adoption supports emissions targets, yet uncontrolled imports could weaken the Ontario manufacturing base that anchors thousands of jobs. From Beijing's perspective, the adjustment keeps a foothold in a sophisticated market governed by strict safety and data rules. The arrangement resembles a pressure valve more than an open gate, designed to test cooperation without surrendering leverage. Such mechanisms are becoming common across international trade, where governments balance innovation with resilience. Will cheaper vehicles accelerate Canada's transition without eroding its factories? The answer depends on how carefully the quota and local supply chains evolve over the next few years. Any adjustment between Ottawa and Beijing inevitably echoes in Washington. The United States has spent years constructing a continental strategy aimed at concentrating sensitive supply chains within trusted networks. Canada's decision to reopen selective channels introduces new variables into that design. American planners must now consider how vehicles, components, or agricultural products moving through Canada interact with their own rules of origin and technology safeguards. The issue is less about allegiance than about alignment of economic policy. History shows that North American partners rarely move in perfect unison, yet their choices shape one another. A managed corridor on Canada's Pacific coast can influence investment decisions in Michigan or Texas, just as U.S. subsidies affect factories in Ontario. This interdependence is the essence of the global economy, where no country acts in isolation. The reset, therefore, becomes a case study in how middle powers reshape larger strategies simply by pursuing their own interests. How will Washington adapt without fracturing the very partnership it seeks to protect? Engagement brings opportunity, but it also revives familiar concerns. Dependence on a single market can return quietly if diversification loses momentum, and sensitive technologies require vigilant screening. Canadian auto workers worry about competitive pressure, while security agencies watch data flows with caution. Ottawa attempted to address these issues through review clauses and product standards, yet safeguards only function if they are enforced consistently. Modern economic policy resembles a set of balances rather than a single decision. Too much openness can expose vulnerabilities, too little can stifle growth and innovation. The reset walks that narrow line, acknowledging that prosperity and caution must travel together. Can Canada expand trade while preserving resilience? The answer will depend on institutions more than headlines, on inspectors and regulators as much as on ministers. The reset touches Canada unevenly, revealing how diverse the national economy has become. In the prairies, renewed demand for canola and pulses offers immediate relief, supporting rail volumes, grain elevators, and rural credit. British Columbia ports gain traffic and service contracts, while Atlantic seafood exporters see the return of a dependable customer. Ontario faces a more complex picture as vehicle manufacturers measure new competition against opportunities in batteries and components. Each region reads the same agreement through a different ledger. Such variation is normal in international trade. Gains in one province can feel like pressure in another, and governments must navigate these cross-currents carefully. Training programs, innovation funds, and infrastructure upgrades become the tools that spread benefits more evenly. The episode reminds Canadians that the global economy is not abstract. It arrives in paychecks and freight schedules. Which communities adapt fastest, and which require support, will determine whether the reset strengthens national cohesion or tests it. Beyond individual sectors lies a broader lesson about Canada's place in a changing world. The country is practicing multi-vector engagement, keeping its closest alliance while reopening additional paths to prosperity. This approach does not replace North American cooperation. It widens the room to negotiate within it. By treating trade as a strategic instrument rather than a routine exchange, Ottawa signaled that middle powers can shape outcomes through precision and patience. The coming years will show whether this balance endures. New technologies, environmental standards, and security concerns will continue to test the framework. Yet the reset demonstrates that Canada retains agency in an era often portrayed as dominated by larger actors. If economic policy is now the main arena of geopolitical risk, then thoughtful agreements become a form of quiet strength. The question ahead is whether Canada can convert this moment into lasting influence without losing the caution that made it possible. Canada's $130 billion trade reset with China has reshaped Washington's strategy, and its implications reach far beyond a single deal. It shows how a middle power can use careful economic policy to widen its choices in a turbulent era. Trade today is measured not only in containers and contracts, but in confidence, standards, and the ability to adapt without surrendering security. The reset reopened doors for farmers, ports, and manufacturers, while reminding allies that Canada will act according to its own long-term interests. The next chapters will be written by harvests, vehicle sales, and the quiet work of regulators who translate promises into practice. For viewers who follow the global economy, this episode is a lesson in how influence often grows through patient design rather than noise. And there you have it. If you found this breakdown valuable, watch our next video. It connects directly to what's unfolding. And don't forget to subscribe. Your support helps us decode these global shifts without compromise. Thanks for watching, and we'll see you in the next video.